Hey everyone, welcome back to Corporate Decoder. Today we're diving into the shareholder report of Columbia Total Return Bond Fund. I know bonds might sound dull, but trust me, there's always a story hidden in the numbers. Sometimes it can be as interesting as the ending of your favorite thriller. This report basically tells investors how well the Columbia Total Return Bond Fund performed over the past year, what it costs to run, and what kind of investments it holds. It's like a report card, but for your money. If you like unpacking reports and finding meaning, subscribe to the channel. Join the Discord community, linked in the description, where we talk about this and more. We are focusing on the shareholder report from April. So the past year it's talking about is actually a report card from May of the previous year to April of the current year. First, let's talk costs. It's always good to look at how much did it cost to run this fund. For Class A shares, it was $77 on a hypothetical $10,000 investment, which works out to zeros, it was $105, or zeros, it was $155, or 1.48%. And for the institutional class, it was only $52, or 0.49%. Important note, these are just hypothetical returns. Your actual returns are going to vary with your investment period. Now let's move on to the real meat of the report, the performance figures. For Class A shares, the average annual total return, excluding sales charges, was 10.31% for the past year. But including sales charges, it drops to 7.0% over 5 years. It's a much more modest 0 to 8 FMPay years. It's 2.0 scored an 8-point index, which is a benchmark they use to compare to. Scored an 8.25% if we include them. Looking back 10 years, it's 2.0 and 0.67% excluding sales charges, and 0.67% excluding, and 1.78% including the charges. The Bloomberg US Aggregate Bond Index, which is a benchmark they use to compare to, scored an 8.0478% including the charges. The Bloomberg US Aggregate Bond Index, which is a benchmark they use to compare to, scored an 8.25% if we include them. Looking back 10 years, it's 2.0% excluding and 1.78% including the charges. The Bloomberg Index did not perform nearly so well in the 5 and 10. Let's now pivot to some key numbers of this particular report. The key fund stats tell us that the fund's net assets are about $2.7 billion. The amount of individual bond holdings is approximately 1,000 of 0.48% of the fund's assets. What is a bit concerning is that the portfolio turnover for an odds of 0.48% of the fund's assets. What is a bit concerning is that the portfolio turnover for the entire $1 million of particular report, or turnover for the entire reportee. Ted will be finally understand more why those were traded so frantically. Now comes the fun part. Let's briefly discuss derivative exposure. On the long side, meaning bets that increase in value when things go up, the fund had exposure of 2.5% in credit risk and 45.2% exposure to interest rate risk exposure. Notice that it holds quite a bit more on the long side than on the short side. An important thing to discuss is what caused the fund to have significant derivative holdings. Fight mean bets that increase in value when things go down. There was exposure of 1.3% of credit risk and 29.8% regarding interest rate risk exposure. Notice that it holds quite a bit more on the long side than on the short side. An important thing to discuss is what caused the fund to have significant derivative holdings. Now we get to what type of assets, categorized by credit rating. The biggest percentage by a large margin is AAA rated, that gets a 41.7% of assets rating, followed by AA with 12.9%, then 11.6%, which would mean it has a portfolio of largely safe government or government-backed securities, much less invested in BBB and CCC, or lower holdings or non-rated. Those lower credit ratings are more risky but have higher coupon rates typically. Now we get into the section to analyze how much did the board, financial officers and accountants make. In 2025, the audit fees were around $5,000 to $1,600 fees. For the tax fees were negligibly higher, going from ATRIT and 2024. It was billed at around $500 to $1,600.94. However, in 2024, it was billed at around $1,500 and has decreased to approximately $470 and has decreased to approximately $474. It was billed at around $5,800 and has decreased to approximately $470,000 and has decreased to approximately $447,400. This needs to be scrutinized to identify if there are any conflicts of interest. While this does not specifically mean there is one, there needs to be research. If we want to actually check individual investments, we can check here, but that would be exhaustive. This channel is not for providing individual investment advice. Fleet now, to talk big picture, what exactly does all of this information tell us? The fund's returns over the past year look pretty good, especially compared to its own longer term performance and its stated benchmark. But you have to put that in context. With a lot of investment grade, so the degree of safety is very high. The derivative portfolio is something that deserves a deeper look to fully understand the amount of risk taken. Tacked to all, the fund seems to be sticking to its stated investment strategy. Okay, that was a look into what goes into Columbia Total Return Bond Fund. What's your take on these funds, and will high interest rate environments persist? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.